Hey, welcome back, everybody. We got Dan Golden with CrossCountry Mortgage. Welcome, Dan.
Hello,
Hey,
George.
so today, Dan and I were noodling on ways to make you guys successful. So, and we thought, okay, so let's do 3 mortgage tips will help you be the most successful in today's market with the mortgage rates bobbling up and down. We've got different loan options, different strategies, other than just, hey, let me go out and get a loan. And so we're going to hit it here. Hang on and let's get at it. Whoop, that was the wrong. You just got to hate it when you push the wrong button. But anyway, so Dan,
Yes.
today, like all other days, we've been getting a lot of information out there. There's a lot of misinformation. In fact, you and I, we were chatting about this one right here when it says, hey, how long does it take for buyers to save for a down payment? And you and I both kind of chuckled because there's a lot of misinformation out there. There's a lot of inaccurate information, and people don't know the difference. The likelihood of somebody spending 23 and a half years to save for a 64.8% down payment. Does that seem a little ridiculous to you?
Yeah, it does. It seems like it's maybe even an AI-driven type thing that somebody spit out there. I'm not sure, but it seems kind of crazy.
Yeah, they did get the part right about the median home sales price of 888,000 now in Seattle, which continues to tick up ever so slowly. We are one of the 5 sweet spots across the United States. But the key thing about, and I guess what I really enjoy about our show is everything is 100% metric driven. It's accurate. It's defensible. It's real. Would you agree with that?
Yes.
Okay. All
Yeah.
right. So let's do this. What started this whole concept off kind of is the taking a look at different options. And one of the ones that I want to talk about up front is the thought of in the option, and we can send this brochure out to anybody. In fact, we'll paste the link down below so you can just get it. Using your current asset as a way to secure a home in advance. And then we'll talk about the 3 tips. And I think one of the important things, didn't I just read that of the top 10 lenders nationwide, CrossCountry Mortgage, I think was number 7. Is that right?
7? Oh, I think
Yeah.
it depends on what you're looking at overall, probably, but
Yeah,
retail,
first volume. Yeah, yeah. And
retail,
I
loan op- retail, we're one of the biggest. I know there's some wholesale, like wholesale lending probably comes up on there, which a lot of lenders are feeding into. But yeah, we're definitely in the top 10. We're one of the biggest companies in the country.
which is super awesome. So when people chat with you and whatnot, they know that you've got a ton of backing behind you, which also allows you to do the 11-day close or to close as a cash buyer in a financed world. And so that's one of the reasons Dan is here, because it allows everybody an opportunity to see different options that are available to you. So let's talk a little bit about the HELOC briefly, and then let's get into the 3 mortgage tips, and then we'll hit the jumbo tips also.
Okay. Yeah, I mean, I've been preaching this for a long time. I've talked about it. A lot of clients coming to me wanting to buy, and they have a home to sell, but they don't want to have to sell before they buy. They want to buy a home and then turn around and sell the house, the departure residence. And the market's strong enough out here where your house is probably going to sell within 30 or 60 days, I would think, after buying a new one. The problem is how do you access that equity? And when you're ready to buy, it's a lot harder to go obtain a HELOC when you're in the midst of it. So if you come to me today or come to George today and say, hey, I want to buy a house, I'm ready to go, I'm looking at houses and I need to pull a home equity loan, it's difficult because they take time. Sometimes they take 30 days, 30, maybe 45 days at times. Depends on where you obtain them. We have them internally, so we can do them pretty quickly. But if you do them ahead of time and get that equity loan ready to go, you don't have to. Most of them are no cost and most of them are like a credit card. If you don't take the money out, you're not going to be, it's not going to cost you anything interest wise. So you could have if you're planning to buy in a year from now or 6 months from now or 3 months from now, go grab that HELOC right away so you have access to that equity. That's one of the biggest benefits to doing a HELOC.
So if I have access to $500,000 and I get a $500,000 HELOC so that I can do my next purchase, if I don't ever put anything against it, well, that's a winner for me then, right? Because there's no cost. There's nothing
right
that I have to pay. But here's a question. How will that affect my buying power if they see, hey, I have access to this monster line of credit?
You don't have, we don't count any payment against you until you access it. So if you have a HELOC that has a zero balance, or a credit, even, same thing with a credit card, you have a credit card with a zero balance on it, we don't count a payment against you with the assumption you're going to withdraw it. Now, if you're going to use that home equity loan for the down payment, we're going to factor that in. We're going to say, okay, you're going to take 200,000 out of this thing. We're going to figure out what the payment calculation is going to be, and we're going to count that against your debt to income ratios. We do also have programs that don't count those against you. There are different programs for people who need, it's kind of a bridge loan situation, but it allows you to pull your equity and then qualify without counting your departure payments that you have on your departure residence.
Okay, so which you kind of hit on. People are going to say, well, what's the difference between this HELOC option versus doing a bridge loan? What's the difference? Why would I do one over the other?
Well, it's a complicated question because it's very specific to the situation. Some people are going to, it depends on what the need is. If you have a free and clear property, sometimes a bridge loan is the better thing. So a free and clear property, maybe it's worth $1 million and you're downsizing and you want to buy 700. I'd probably just pull 700,000 out of that property you're selling on a HELOC or some sort of a equity loan or bridge loan. We have bridge loans that will do that too. That when I say bridge loan, all that is it's basically just accessing your equity. It's basically like a HELOC essentially, but it's allowed to be done during a transaction. When you try to go if you have $1 million loan free and clear, or excuse me, home free and clear, going out and getting equity in it when you're in the midst of selling it is really difficult. Normal banks don't want to lend on a home that's for sale. Right. But we have what's called a bridge loan that allows us to do a loan when the home is for sale.
I think that's the distinction that I was really looking for. HELOCs, your home is not on the market for sale, whereas a bridge loan, most of the time, the subject part of the home that you are going to depart from is for sale or will be momentarily.
Right.
Okay, which is a disclosure item that they're going to want to make. So perfect. Yeah. All right. Different question then. When we talk about HELOCs, you say they take 30 days, 45 days. You say there's no cost up front for many of them, not all of them, but many of them. Right. Is this also credit score driven?
Yeah, they're they're gonna pull credit, and if you have an inquiry, it's gonna show up there. And the rate and fee structure for a home equity loan is score driven. We internally in our company have scores down to 680 for a HELOC. You usually need above a 680 to get a HELOC. If you have lower than 680, it's going to be difficult unless you have just a lot of equity. So if you have a lot of equity, it'll minimize the amount you'll be able to pull out, but lower than 680, you'll have some issue. So if you're above 680, you can typically go to 85 or 90% of your value minus your mortgage that you currently have. So $1 million home, if you have a $300,000 mortgage and we do an 80% loan to value HELOC, which that's $1 million times 80%, which is 800. And then we subtract out the mortgage you owe, say you owe 300, we could give you a line of credit for 500 in that example. Okay. That's pretty typical. And then you use that 500 for the down payment on the new property.
Okay. Let's not delve too much more on that. I think it's a really creative option. Who would be the perfect target buyer that you would recommend this for?
Anybody who thinks they're going to buy in the next 3 months to 5 years. If you think you're going to sell your house down the road and want to buy something else without selling, I would do a HELOC as soon as possible. It doesn't cost you anything. You don't have to draw the money. It doesn't cost you interest. It just sits there on attached to your title. It is on title and it is a lien, but it's anybody who plans to buy soon, even within maybe 2 months, if you're thinking of it, I would go get a HELOC to see so you can have the access to that equity when you need it.
So really, at the end of the day, if you're looking at purchasing a home, if there's an option that whether it's a 2-1 buy down and you're not able to negotiate with the seller to cover it, or if there's another oh my gosh, if I just had just a little bit more, I could step up to this house while negotiating or something along those lines, or hey, it allows me a greater down payment if necessary, then it allows more flexibility for a prospective buyer. Would you
Right.
agree with me?
Yeah. Putting like for example, putting 25% down instead of 20% or 15%, there's a benefit to that on the next property. So if you can, if you can do that, you're going to save money.
Okay, I agree with that. All right, so HELOCs as a alternative for a lot of buyers out there, so that own a home, utilizing the equity that you have in your house, since most of the time that's going to go there. But let me ask you a different question. What if you are going to keep the home that you get the HELOC on as a rental? Let's say that I've got this house, I've got 70% equity in my house, and I have a mortgage interest rate of say 3%, which is very common with a lot of folks that as we know, refinance between 2020 and 2022. How would that affect everything as they were? And I know that's a big ask right there.
Yeah.
How would that affect, or how would somebody still be able to benefit from it on that level?
Again, it's just a matter of having access to that equity. And one thing about what you said, that's the reason I say to do these ahead of time. Once you decide you're going to buy a house, a new property that you're going to live in, your current property in the eyes of every lender becomes an investment property. Even if you're going to sell it or rent it, even if you're still living in it, even if you're going to live in it for 3 more months and you're not going to buy for 3 months, we're going to look at that departure residence as a future non-owner occupied or investment property. And so obtaining a HELOC on an investment property is really difficult. It's not impossible, but the terms are worse, and the LTVs are lower. It's harder to do and it's more expensive. So if you think that might happen, that's why doing it ahead of time while you're still officially a primary resident, even if it's going to be 3 months before you start looking for a house, it's better to get it up front. But to answer your question, it allows you to keep that 3% rate if you're going to rent, keep that nice low rate, and then still pull equity out if you need it for the new purchase.
Right. And that's one of the things that we wanted to make sure everybody understood, that just because you get a HELOC to buy your next home doesn't mean you need to sell it. There's a number of clients that we chat with. They're like, oh my gosh, I've got this 3% rate, and my mortgage payment, versus what I could rent it for, I'm more than cash flow. And so, the recommendation is, hey, listen, take your home, get your HELOC. You can pull money out as needed to help with the purchase of your new home. Let the rental property carry that debt service and the HELOC debt service. So it's almost like getting free money, or somebody is paying for that ability for you to purchase your new home and continue your asset gain and equity gain, for your future retirement. Would you agree with that logic?
Yeah, and then your HELOC becomes tax deductible because it's an expense on your rental. So there's some pros and cons there too.
Yeah, it allows you to remain liquid in your own personal accounts, which gives you that internal comfort, knowing that you didn't drain your account to buy the new home, just so that you could keep the other home as a performing asset. So,
Right.
all right, fair enough. Let's do this. Let's get on to what we were going to talk about. 3 mortgage tips for buyers to be successful in today's market. And it's super important that I think a lot of people need to understand. Dan, you and I have been, doing a lot of, educating and whatnot. And we have, the do's and the don'ts, what people should do, what people shouldn't do. The natural ones, keeping, the lender informed, making sure that, you pay your mortgages or your rent. Don't open any new accounts. What the number one people I don't know why, but the number one don't buy a car before purchasing a home. And then the second one there, don't make any major purchases. Why do people not want to do this, Dan? Why is this important?
Well, every time you apply for a car loan or any kind of credit while you're in the process of doing a mortgage, we're going to get alerted. So a lot of people think, oh, they pulled my credit. Now it's, that's a one-time shot. But we are alerted anytime there's an inquiry on your credit, and we're going to ask you, hey, what happened here? We saw you had an inquiry. Oh, I went and bought a washer and dryer for my potential new house that I'm buying, or I'm getting ready to get a credit line so I can buy furniture. We have to count that debt against you. And if you're on the edge of qualifying or your ratios are, at the top level, especially if you have a departure residence, it might be at a top level because you're counting a departure residence. That payment has to be addressed in your ratios, and it could cause problems. It could cause you to go above the threshold that we're at. And I have had people just, and they do call me and say, hey, I'm thinking of buying a car before we buy, and I'll ask them, well, what's that payment going to look like? And sometimes it's okay. Sometimes it's not a big deal, but make sure you're talking to your lender. If you buy something and then we find out and it causes your ratios to go too high, we have to pivot and figure out some different strategy. Maybe you have to put more down or maybe something else, but it puts a wrinkle in everything. So just be cautious of any kind of new credit inquiries and new debt.
I think most people don't understand when. So if somebody has, let's say their total qualifying dollars is $5,000, and I'm just going to use easy numbers. If my total qualifying income is $5,000, and I go out and I buy the car of my dreams, and that payment is $1,000, I no longer have $5,000 that can be applied to a mortgage. I now have $4,000.
Right.
Which that could be $100,000 in buying power alone.
Right.
Is that a fair statement?
Yeah. So just wait till after the house closes, and then you can go buy if you want to add more payments to your debt load at that point, you can. Car lending is a lot more flexible than mortgage lending on the ratio side. So you'll still be able to get that car loan. Just hang tight until you close.
Okay, so let's go ahead and let's bring this up. So here we go. Number one, improve and maintain a strong credit score. Dan, why is having a strong credit score absolutely important for people looking at buying a home?
Well, we look at credit score in 20-point increments, and every 20 points goes like every 700, 720, 740, 760. And those are the breaking points. So anything in that high level, the higher levels above 740, 760 is going to give you the best pricing, the best rate structure. It also, once you get down below certain credit scores, you're going to have to put more down or pivot to different programs that aren't as attractive. So the credit scores.
So what you're saying is if somebody wants to save money, it behooves them to have the best credit score.
Right. Yeah. The scores are very, they're going to change the rate and fee structure.
Yeah. So if somebody is looking at making a home purchase,
mm-hmm.
and I commonly tell folks this, when the introduction is made to, a qualified lender, you have this super cool tool that you can plug in their information to help them improve their score. Is that right?
That's right. Yeah. And for most of the time, you can do it. It takes 30 to 45 days to improve your score. We have what's called a rapid rescore,
Mm-hmm.
and that still takes a few weeks. So it can't be like, I want to buy a house and close in 2 weeks and, oh, I want to improve my score. It takes longer than that. But if you're ahead of the game, you're doing your research and go to apply. And by the way, we only do a soft pull credit report. So even if you're not thinking of buying for 4 or 6 months, it is a good idea to talk to a lender, have them do a soft pull credit, make sure you specifically ask for that because a hard pull credit will affect your credit score. Have them pull a soft pull credit, and I can look at that and say, you know what, you're at 719 or 729. If you get up just a little bit, you'll be in that next credit level that'll save you some money. And I can tell you what you need to do. I can say, this is the steps you need to take over the next 60 days. It'll approve automatically. We don't even need to do the rapid rescore if you're that far out. If you're closer in on that, I can do it. I have a process that allows me to do it quicker for you.
Okay. So when we talk about this, we talk about keeping credit utilization below 30%. And some folks, they just don't understand the why. Why is that important in the eyes of a lender and when it comes to credit?
It's important to the credit scoring algorithm because basically I think, the algorithm is under the impression that if you're maxed out or close to maxed out on credit cards, that you're somewhat of a risk. So it's going to lower your score. So to explain the 30%, if you have a $10,000 credit line on a credit card, you want to keep that balance under 3,000 if you can. 50% will be okay, but 30% really improves your score. But try to keep those credit cards under 30%, even if it means, this sounds crazy, but opening another credit card. So if you have a credit card that's $10,000 limit and you have $6,000 on it, if you can, go open another $10,000 credit line and transfer that 3,000 balance over to the other one. Now you have 2 credit cards with 30% instead of 1 with 60. That will improve your credit score, and that will help you save money when you go to buy a house.
Right. Because when we talk about money, we're not talking about $10, $20 a month. You're talking hundreds of dollars a month in difference with, our medium price points in this area. Is
Right.
that safe to say?
Yeah. Or conversely, the cost to buy down a rate to the normal rate with those credit score add-ons, thousands of dollars.
Okay. Let's move on. And point number 2, increase your down payment and reduce debt to income ratios. We kind of chatted about this. There's a lot of folks that are still under the perception, Dan, that they need to put 20% down. Oh, I got to put 20% down. Gosh, MI is evil. And I laugh sometimes because I'm like, well, wait. Look, if you did, 10 or 15% down, sure, you may have a small amount of MI, but the difference of your MI payment, mortgage insurance payment, is far less than the reach of putting that extra 5 or 10% down. Can you touch on that a little bit for folks today?
Yeah. So, I try to put my financial planner hat on when I talk to people. And if someone says, I really need this payment to be under X, I totally agree with that. And I'll look at that and I'll show people, here's what you qualify for. If you put maybe less down on a prop, maybe that means you have to put 25% down. Maybe that means you have to pull money where you don't want to pull it, like sell stock when they're on the downslide right now. Maybe you don't want to do that. That might be more costly to do that than to just put less down, 5 or 10. I mean, we can go 0 down on some programs, but 5 or 10% down versus 20, then you're not pulling that money out of your stocks that might be down, incurring a tax liability. And maybe that's going to cost you $50 in mortgage insurance every month. And that's temporary. Mortgage insurance is not forever. You can get rid of that mortgage insurance. You can drop it after a certain period of time.
You absolutely nailed some of the target folks that this is directed at when they take a look at, their RSUs and, some of the rules and guidelines, and some of that has changed. And so that perception of, hey, I have to put 20% down because I don't want mortgage insurance. That's something that once people start to get educated, they start looking at the cost analysis, especially like you say, you have a tax implication, when you sell stock, and that's a it's a payment that's forthcoming depending on how much. And when you balance the two, that just doesn't make sense. So I think that's super important, and the point on what we're looking at as far as making sure that we look at the big picture of cost, actual monthly mortgage cost, and asset return. So, all right, let's bump into this one. Get pre-approved and work with a knowledgeable lender. Now, some people might be saying, what does that mean? Aren't all lenders the same? That answer is?
I say no.
I would agree. I would agree.
Yeah. I think there's a lot of what I call order taker lenders out there, and they're basically they really haven't been in the business a long time, and they are hired to basically just take information, and the information is only as good as it's given. Some people are, example, self-employed people. Oh, I make $100,000 a year. Once I see those tax returns, maybe you do a lot of write-offs and maybe you only make 50,000 a year in our eyes. Go to some of the big banks and some of the internet lenders and what I call order taker lenders. They're just going to take your word verbatim and plug everything in, and they say, yeah, you're good to go. I get a lot of people go, yeah, I got pre-approved for $1 million, and I'm looking at going, I don't know if that's accurate. And then they come to find out after going through the process, oops, and this is maybe 3 weeks later, they don't get quick information, and they're told they're kind of the rugs pulled out from under them. So I try to do a lot of that work up front. I do a lot of that work up front. We analyze the tax returns and income and all the factors that go into an approval. And then we can actually put it in front of the underwriter, who's the final decision maker. 99% of the time we are correct in our analysis, but it's good to have that second set of eyes. And then you can officially say you're a fully underwritten borrower and you're ready to go. Everything's been reviewed and analyzed.
You hit on something that's really important, and we get this question a lot, Dan. And hey, what's the difference between pre-qualified and fully pre-approved, and why should I go through the efforts? Or we hear you know what, our lender doesn't they don't run you all the way through underwriting. And what is the very clear distinct difference as far as a buyer understanding their risk for their earnest money, for their purchase, the difference between a pre-qualification and being pre-approved, fully underwritten?
Pre-qualification is, what I mentioned, is someone just taking what you're telling them, which I'm not saying anyone's not being honest, but we have to look at everything in a specific way. And some people, like the example with the self-employed, some of that information has to be analyzed. And so pre-qualification is someone doing kind of a quick view of it and saying, yeah, everything looks pretty good, you should be able to buy this house. And pre-underwritten is someone who is making the final decision on it and it's like rock solid if you're underwritten approved, and you're going to win your offer you'll have a lot stronger offer going in if you have an underwritten file. And so these are the things that I think help win offers, and there'll be no surprises, essentially, is the main point.
Right, because there could absolutely be something that is going to kick out a loan, whether it's a change of credit score, maybe the vesting timeline or the type of RSU that somebody is going to use for a purchase, maybe some income. If what is it we've run into that they get bonuses or commissions on top, but they don't show the consistency that can be used for a qualification for purchase, albeit they will receive it and they include that in their income, saying, oh yeah, I receive this every month. but there's not enough consistency of pattern. Have you seen that
Yeah.
before?
I see it all the time. I'm working with some clients right now that are the guy's a union guy, and he's makes great money over the last 6 months. But in the last 2 years prior to that, just it's typical for his business. I think he's a plumber, and he has times where he's not busy. And so right now, in the last 6 months, if you look at his income, he makes, let's just call it $10,000 a month. But last year, he made the average of $8,000 a month. Well, in that type of job, we have to factor in that there might be some gaps of time that person's working, and we have to assume that might happen in the future. But that client calls me and says, "Oh, I make 10,000 a month." If I start pre-qualifying him on that number, and then 3 weeks later come back and go, "Hey, I just realized you're a union guy and you've had some sporadic gaps of employment over the last 2 years," underwriter's gonna lower that income, and so that's a risk.
It is, and that is one of the biggest benefits to being fully underwritten is that all of that is vetted out. There's no questions asked. This is exactly all I need is a satisfactory purchase and sale agreement, satisfactory appraisal, and a satisfactory title, and I can close.
Yep.
Right?
Yep.
Okay.
It happens with assets too. I wanted to throw this out there really quickly. We just had this happen. Someone says, "Oh, I have 300,000 for a down payment." Oh, great, you're qualified. Then I get the bank statements, and I have it. Some of these lenders don't look at these things till they go to underwriting, which might be 2 or 3 weeks. We underwrite up front. Let's say those asset statements have a $200,000 cash deposit, and we can't track it. We don't know where it came from. They got something from overseas or something.
Right.
We can't use that money. It's got to be money that's been in your bank account for 60 days. If it's some weird cash deposit, we have to retract that money.
Okay.
In our eyes.
Let's hit on that really fast, because we just had this issue, right? Where they started moving funds in. They were gift funds, right? And they're like, hey, the parents are gifting. It was a sizable amount, for them to purchase the home. And all of a sudden, the documentation. So if somebody receives a gift, let's say, my parents are going to help me buy a house, and they're going to gift me $200,000. Okay, what should a prospective buyer consider when they're looking at getting a sizable gift like this, or any gift, in the eyes of a lender? What do they need to do? What should they prepare for?
Well, they have to make sure that the giftor, in your example, your parents, are willing to sign a gift letter. So there's a gift letter that they have to sign that says, "We are giving this money to George, and we do not expect any repayment." They have to sign that. And so we send that gift letter out we would send that to you and say, "Hey, make sure your parents are willing to sign this thing." And I've had parents that don't want to sign it.
Right.
And we can't use it if they won't sign it. So, and then we have to also, there's a certain procedure in the money movement. When that money comes to you, George, how it comes to you, we have to track that and make sure it came from them in the account that they specified on that gift letter. So there's some pretty specific stuff that has to happen on a gift. And if you don't follow those things, it can be a problem in the end.
Okay. What if I wanted to buy a house, and my best friend, Dan, wants to gift me $100,000 so I can buy a house?
Best friends?
Can I get that? There's no familiar relationship, regardless of how extended. Dan is just a buddy of mine, and he's going to give me $100,000 to buy a house. Does that work?
Yeah, it has to be a relative. There are some stipulations on certain loans that if it's like a lifelong friend, like let's say you raised me as your son or something like that, all right, that kind of thing, and you've semi-adopted me or something like that, and then I give you a gift, you can track that relationship, but that's only on certain types of loans. Most normal, conventional jumbo loans, they want it to be from a relative only, period.
So if it's a coworker or somebody I went to college with, and they're doing much better, and they say, "Hey, I want to give you money to buy a house,"
No,
doesn't work.
No good.
I just wanted to differentiate, because some folks, we've heard, oh, hey, yeah, my really good friend, they're gonna lend me $100,000 so I can finally buy a home. And I'm like, hey, that's not gonna work unless you
Yeah.
can show familial relationship,
Right.
or they're gonna adopt you. Are you up for adoption? I'm up for adoption at that point, right?
Right.
So anyway, all right. Let's talk a little bit about what we see in our areas, jumbo loans. And so let's start off with first, what the heck is the difference between a regular loan and a jumbo loan? What makes me a jumbo loan buyer?
So there's jumbo loans are any loans that are over 806 and some change loan amount. There is something called high balance, conforming high balance, but it's essentially this kind of the same as a jumbo loan. It allows for a few features, and that's between 806 and a million. I think it's 1,040,000 or something like that.
Right.
And then after 1,040,000, you only have jumbo lending. But the high balance bucket, that 807 to 1040 bucket, it's very similar to a jumbo loan, but it allows for lower down payment options.
Okay.
The pricing is sometimes a jumbo loan is better rate structure. So what we do is look at you're over that 806 loan amount, we look at both jumbo and high balance, but they're just different. It's a different category, and they're a little more restrictive, but still not that hard to obtain.
Okay. So let's talk about this. When we deal with the jumbo, naturally, having a strong financial profile and whatnot, credit scores, a lot of these programs are very much credit score driven along with liquidity. Dive into that a little bit for these guys.
So yeah, jumbo lenders are a lot more specific on credit scores. I think they go by 10-point increments instead of 20, and then it goes all the way up to 800. So a 790 credit score person might not get quite as good of a deal as an 800 credit score person. So it's pretty kind of minute changes that affect the rate and fee structure. So typically you can get jumbo loans over a 680 score, but you're going to pay the price for that a little bit, having those low scores. So scores are very important on jumbo. And then if you're at a certain level, you can still get a that's another reason the high balance buckets there. They'll accept lower credit scores than some jumbo lenders. And so that's why that is still an option to look at. So we can look at all those options.
So when we talk about lenders and certain lenders having certain what we would call programs or overlays on programs, is it safe to say that different lending institutions will have different programs depending on who they're trying to capture as a client? And can you kind of talk a little bit about when somebody is out, other than the 5 questions to ask during when getting quoted mortgage rates, what should people be mindful of that you're seeing today with some of these jumbo loan buyers?
Well, the jumbo, we have I think 10 jumbo what we call investors, which is where your loan will end up eventually. They're usually big banks or financial organizations that will insure these loans for us. So there's different investors that have different risk thresholds. And so if you go to a lender that is only has one option for their jumbo, you're going to be limited. All these investors go in and out of the market based on their risk level they're trying to stay within. So you might have, and they do that by pressing on the lever of the rates. So some of the really good investors that have really good pricing are trying to build their portfolio. And then you have others that maybe have more flexible guidelines. They'll raise the rate up because they're taking on higher risk. So there's different it's all based on risk, and the rate and fee structure are based on that. And some lenders have, they'll allow higher debt to income ratios. They'll go to 49%. Most jumbo lenders are limited to 43% debt to income ratio, but there are some out there that will go I have some that will go to 55, but those are going to be more expensive and sometimes require higher down payments. and some allow lower down payments and higher down payments. So there's a lot of options, and it's all going to play out in the in the pricing.
Okay, I would agree with that. All right, thank you for popping over to that one. Let's open up. Item number 2: lower your debt to income ratios, or what we call DTIs. You kind of hit on that one. Being below 38% is good. Being below 35% on jumbos is really good. You had mentioned that they can go up to as high as 45%. What would be let people understand clearly, debt to income ratio, gosh damn, what does that mean? I make, I'm going to use a round number, $10,000 a month. And right now, I pay rent of $3,500 a month, and I've got a car payment of $1,000, and I've got some credit cards, say maybe $500 a month. Okay. When you look at that debt to income ratio, can't I just say, hey, I can take, 45% of my $10,000 and I'm good to go?
No, yeah. What we do is we take your gross income, like you said, 10,000, and then we do a calculation based on what your debts payments are every month. So your mortgage or housing debt, then you add in those other things that are on your credit report. It's pretty much, there's other items that come into play, but pretty much only what's on your credit report. So a car payment, credit card payment, student loan payments, and student loan payments, if they're deferred, we have to figure out a payment associated with that. We don't just accept that they're deferred, because they're not going to be deferred forever. We have to assume you're going to be paying those. And then the only other things that come up outside of that are other debts, like child support. If you pay any maintenance to an ex-wife, anything like that, that aren't on your credit, those will come to play as well. But you add those up, and then you divide it into your gross income. So I think everything that you said added up to about 5,000, 3,500 plus 1,000 plus 5, that's 5,000. In that scenario, your ratio is 50%. So, that's pretty high. That's on the edge of, 50. You can get loans at 50% debt to income ratio. They're out there. But typically we want to keep you under 40 if possible.
It gets painful when you get up in the 50 percentile. That's just high risk.
Yeah.
I think that's super important for some folks to remember, that you hit on, student loans that have been deferred. They still have to be accounted for, because like you say, they have to be paid, inevitably so. And then, when you talk about, spousal maintenance or child support, some folks forget, hey, yeah, I make $10,000, and they don't realize that payment for spousal support or child support, that comes right off the top. And what you then are left over with, to qualify with, can be significantly reduced. And so that's, here's one. If you have somebody who's looking at buying a home, and they are late on payments for child support, how does that affect that borrower?
It's all, it's going to affect the child support. Won't necessarily affect your credit score because it's not reported, but any late payment on your credit report is going to have a massive detrimental effect on your score. So number one, your score is going to go down. Number two, we might not even be able to approve your loan. If it's an isolated event, usually it's not a problem. If you made one late payment a year ago accidentally and it's pretty obvious, that's not going to, it'll still hurt your credit score likely, but it won't hurt your approval. Late payments on child support, if we see that could be a problem. That's kind of an underwriter discretion depending on the situation. But if you're delinquent on child support, sometimes that'll come up as a judgment too on your credit report if you've been taken to court for past child support. So we have to account for that, and if it's late, they're going to look at that and make a decision.
Okay.
Depending on the situation.
Right on. So number 3, work with a jumbo savvy lender and get fully underwritten and pre-approval. I guess, really at the end of the day, especially when dealing with jumbo loans and the amount of earnest money at risk, and the emotional element of buying a home and then all of a sudden you can't qualify and things like that. It's there's nothing more stressful, right, than looking at, hey, I've got, 50, 60, $100,000 of earnest money now on the chopping block because I did not start with somebody who can perform and close a loan. Like you say, they were just an order taker. What feedback can you offer people today on that?
Well, it's just the biggest feedback is that they have to, yeah, everyone has to understand that jumbo lending is very, very black and white. There's no room. There's not a lot of room. There is some room, but there's not a lot of room for flex in the guidelines. And jumbo lenders they'll change their guidelines as, like I said before, as they want to push on volume or not receive more volume because they have too much. And it sounds weird having too much volume, but some lenders, they get to a point and they want to slow down the production coming in. And so they'll step on price or they'll change their guidelines and make it harder to qualify. So having a lot of investor opportunities is helpful because, I have investors that will take up to a 45 or 50% ratio. I have some that will not. And maybe I plug you into one. If you have a lower ratio, I plug you into one of the lower jumbo lenders. But if you have a higher ratio on lead, I have other options for you. And so it's good to have a lender who has, number one, a lot of investors, which we do, and one that is very good at looking at the guidelines and understanding them and being very specific on the guidelines, because they are very specific to each investor. So when a client comes to me, I look at their situation and I have to say, let me call you back, and I need to do some research on which jumbo investor fits the best for their, number one, their qualifications, and number two, the best pricing for what they fit into.
Okay, I think that I thought that was a great overview, and letting people know what that risk level is and what they need to really consider at the end of the day as they're making their planning. Again, it's just that absolute get pre-approved, get in front of the underwriter, get the eyeballs of the person who's going to give you a thumbs up or a thumbs down, and how can we make that work, or will it work, or what changes need to happen before you ever step into making an offer on a home. Safe to say?
And there are a lot of, one more add-on is there are a lot of jumbo lenders, banks, and even just normal lenders you see out there that do not pre-underwrite jumbo loans. We do. There's a lot that do not. And so just be aware of that. Like, make sure you ask that specific question: are you underwriting my loan?
You hit something that's super important. We talked, we glossed over it earlier when we mentioned the word add-on. Many times with home buyers, especially with first-time home buyers, when we talk about, hey, you're going to look at par pricing today. Let's say par pricing today is 6.5, and then but you're going to buy a condo. Okay, well, there's an add-on, meaning there's an increase in rate that will be for that. Or if you're going to buy an investment multifamily, hey, there's a add-on for that, because it's based on risk. But with jumbos, like you said, each lender has their own add-on, meaning an additional layer on top of what that base program is. So if they are talking to an order taker who is not vetting all of the specific add-ons, what's the outcome?
They're going to get a big surprise, and it's like, oh, whoops, sorry, I forgot. We have to add a point because you're buying a condo, and I was pricing everything as a single family. And so you don't want that at the last minute or mid transaction. You want that ahead of time to know what you're up against. And
right. And a point being 1%, half a point being 0.5%.
Yeah. In cost. When I'm saying that, I'm talking cost. So $1 million loan at 1% is $10,000 cost. 0.5% $5,000 cost. So that could come into play.
Yeah, that could mean that kicks somebody out because they may not have that extra money to put down because of the overlay.
That's right. Yeah.
Okay. All right. Just to let folks understand that it's not, oh, here it is. You know, you have to have this credit score. You have to have this. You have this. Here it is. No, no, no. We have these overlays on top, or criteria that have to be met. And if they don't, it kicks you out of a loan program.
Yeah. One little exercise is whenever you see rates online or whatever posted, do yourself a favor and read the fine print, because it will tell you this is based on 25% down, single family residence. It gives you all the parameters. So anything off of that, that's going to change that rate that they're advertising.
Let's talk a little bit about a bonus tip here. You're prepared to put 10 to 20% down. Some lenders require 20 to 30%, especially for investment or second homes. When we talk about what people need to start qualifying, because, you know, they get ready to do a loan, they're like, oh my gosh, totally. What do I need to get a loan? What do I need to start gathering, and how soon should I get that to my lender?
Well, the first step that I always tell people is apply online, and that I have an online application. It takes like 15 minutes, and then I can, you know, it actually generates what it generates what it thinks you need, what it thinks you might need, and it'll tell you, you know, if you plug in that you're a salaried employee, it'll ask for W-2s and pay stubs, bank statements for 2 months, W-2s for 2 years, bank statements for a full month, and bank statements for 2 months. If you're self-employed, there's some additional information we'll need, as you have on your list there: tax returns, full tax returns for 2 years. And then, you know, that can, after we receive that initial bulk of documentation, it can trigger more documentation. So be aware of that. But for the most part, W-2s for 2 years, pay stubs for a month, tax returns if you're self-employed, or there's some other reasons we might need tax returns. Like if you have a rental property already, we have to have tax returns, and then your asset statements for 2 months.
Okay. So when we talk about, you know, making your application and they get done, it's normally good once they make application, get all the information. How long is that good for?
The documentation has to be updated every 60 days. So if, you know, if your pay stubs were 2 months ago, I'm gonna have to just get new pay stubs. It's typically not a lot. And so to answer your question, 60 days. The credit report, we do a soft pull credit report, as I mentioned before, and we don't pull a hard pull until you're like really close to making offers, or you're in, like you win an offer, and then we'll pull a hard pull. The hard pull is good for 120 days.
Okay. So we recommend folks to, every time they receive a pay stub, send it over to you. Every time they get their bank statement, send it over to you. And that keeps that application period or process, that pre-approval process, updated and ongoing. Is that a fair statement?
Yeah.
And how often, Dan, do you get contacted at 3 o'clock on a Sunday with a panicked buyer to buy a home, and then all of a sudden, you know, you realize, you know, gosh, guys, you didn't follow through and update the information? Do you see that often?
Not super. I mean, it happens, but, you know, if something major changes, that'll be a problem. If nothing's changing on your profile, I mean, getting those updates should fix it. But if there's anything that's changed on your buyer profile, if you've, you know, stopped, like maybe you were earning overtime consistently and now you're not.
Right.
So we see that pace and we go, wait a second, you were doing overtime consistently, now you've dropped that. What happened? Like that can be a problem. Something like that. If anything changes on your profile, or you're all of a sudden we had $100,000 to make and now you show 50, like, what? Wait a second, what happened here? Do you still have the 100? Or, and, you know, maybe you're not even putting 100 down, but maybe we needed it for a reserve. So, you know, there's down payment and then there's reserves. If your reserves go away, that could be a problem for the profile. So it's good to keep those updated for sure.
Yeah, it's I was kind of baiting you into to a problem that we see often. Folks, they make application and then they just forget. Oh, I'll do that tomorrow. Oh, I'll do that tomorrow. I'll send in my information later. Oh, I'll do that. And then all of a sudden their pre-approval, goes away, and then all of a sudden the perfect home comes up,
Right.
and now they're scrambling to get a pre-approval, which is required to present an offer. And it sometimes makes it unnecessarily stressful. How's that?
Yeah, we try to remind people, like, we, after 60 days, if we don't hear from them or we don't see a new pay stub, we'll ping them and just say, hey, do you want to keep your approval updated? If so, send us these 3 pieces of paper. And typically that's what they do, and we're good.
Right on. Okay. Well, any last parting words that you would like to, any folksy wisdom you would like to pass on to the people watching the show that will make them more successful?
I think just talking to a good lender who has a financial planner mindset that will look at your whole picture and help you, guide you into a strategy that's going to fit best for your needs. That's what I recommend to everybody. Work with someone that's accessible, available. I hear a lot of people that are working with certain lenders and banks that, they're only open 9 to 5. And, I work weekends and evenings, and, I know you can attest to that, George. And sometimes that's what you need. You need that kind of service. So don't get caught up in some minute rate and fee differences when you're dealing with the biggest purchase of your life. I think I see people like, stressing over a $300 additional charge for something. I mean, you're buying $1 million house. That's a penny.
Yeah.
When you compare it to what you're buying, and if you're going to give up, lose your earnest money or have bad service or not be able to win that offer because the lender's not available,
right.
That's what I'd say is just work with someone that you're accessible and will have your best strategy in mind.
Okay. Fair enough. Dan, as always, I appreciate your time. We'll, for everybody, Dan Golden with CrossCountry Mortgage. We'll put all of his information down below for you guys. In the meantime, we'll see you guys on the next video. And Dan, thanks again, buddy. Have a great day.
Thanks a lot. Have a great day.